Hi, and welcome back. In this week's lecture, we're going to talk about the cost of capital, the weighted average cost of capital for the firm. We'll do it in two parts. We'll talk about the most common sources of capital for the firm. The first source of capital being equity. The firm can sell shares in itself, equity shares as a way to raise capital. And the second being debt. They can raise debt financing, either public or private debt financing. We're going to talk about the ways to establish what kind of financing has been raised, the ways to value that kind of financing, and then the ways to calculate the required return or the discount rate on each source of financing. And all of that is in the context of talking about the firm's cost of capital. And specifically, when we do a discounted cash flow model, we take the present values of the free cash flows, we discount the free cash flows at the weighted average cost of capital for the firm, more commonly called the WACC. So this is the opportunity cost for investors, but more commonly we think about the WACC just as the average level of risk for all of the firm's investors. And so this is the risk that they take when they provide capital to the fund or to the firm. And so it's also the hurdle rate for the firm, because the firm must provide return that satisfies the level of risk that investors has taken on when they provided capital to begin with. Right? So in the simplest form, when we look at the WACC, we just consider the two main sources of financing for a given corporation, for a given firm: debt and equity. So you can see the formula for WACC here. It's starting with the term that considers the firm's debt. We see the value of the firm's debt, D, divided by the total market value of the firm, V, times K sub D, where that stands for the the cost of debt for the firm, where the cost of debt is the required return on the firm's debt. And then we have a term 1 minus the tax rate for the firm. And this is because debt financing is considered less risky, because for the firm at least, paying interest on the debt acts as a tax shield. And so there isn't what we call an interest tax deduction. This makes it slightly cheaper for a firm to raise debt, simply because it can reduce its effective interest cost because of the tax deduction. So to the firm, the cost of debt is after tax, plus the term for equity, which is the market value of equity, E, divided by the market value of the firm, V, multiplied by the cost of equity here, K sub E. Now you'll often see these, sometimes this formula written with an R instead of a K, so R sub D, R sub E. The K here is written because we're sort of in this discussion, this lecture, we'll talk about it as a cost to the firm, but you'll often see it written with the R because lots of people talk about this in terms of return to the investor. And ultimately that's because these are the exact same thing, right? The cost to a firm of raising financing is precisely the return the firm gives to the investor for providing the financing, right? Now this is really easy to think about in the context of debt. If the firm takes out a loan, the cost of the loan is the interest payments the firm has to make. The return to the lender is the interest payments they receive, right? So the cost and the return are precisely equivalent. It's just that one entity is bearing the cost, that's the firm, and one entity is earning the return, and that's the lender. Now with equity, it's not quite as straightforward, because equity holders aren't paid a designated interest rate. And while they might expect to receive some profit sharing in the form of dividends and hopefully price growth, they aren't promised that like a debt investor is promised it, right? Remember that debt, or maybe you don't remember, but you should know that debt is sometimes called a promissory note because this is what's promised to them. Equity isn't like that. When you buy a share, you don't get a promise from the firm to pay you 10% dividends until you sell your shares. That's not how equity works. You get a lot of rights as an equity holder, but monetary promises aren't one of them. Right? So when we think about the cost to the firm of raising equity, or the return to the shareholder of raising equity, it's not quite as clear cut, but it still has the same interpretation. In other words, equity holders provide financing with some implicit cost in mind. They have an expectation about the return that the firm should provide based on the risk that the firm undertakes. And even though this isn't promised, it's expected. And so what the firm then has to do is try to understand how to satisfy this cost by taking on projects that only increase the relative value of the firm and thus provide the return to the investors, because when the projects increase the value of the firm, they also increase the share price of the firm, and that's how investors get the expected return that they're after. Okay? So it's a little more nebulous, but that's what we're going to talk about in today's lecture. Right? So when we determine the weighted average cost of capital, we're looking for three things. We want the cost of equity, the after-tax cost of debt, and the company's target capital structure. Remember, capital structure is the relative percentage of debt and equity used to finance the firm. Right? Remember, the capital structure specifically refers to that right-hand side of the balance sheet, owner's equity plus liabilities. Right? So that's debt and equity. What we want to know is, what kind of structure did the firm undertake when it raised capital? Is it 50% debt and 50% equity? Is it mostly debt and only a small percentage equity? Lots of firms are the other way. Say 80% equity and 20% debt. Remember, we talked in, even in just the last lecture about debt ratios and liquidity and leverage and how that can put the firm at more risk if they have lots of debt. But what we're trying to figure out is, what kind of capital structure is the firm going for? Not every firm is going to use the same capital structure, and we talked about that too, how some firms have appropriate levels of debt that far exceed the appropriate levels of debt for other firms. So the capital structure, even though you might hear people talk about optimal capital structure, if you ever sort of go on and take more advanced classes or go work at a bank or something like that, optimal capital structure is a little bit misleading, because that would have to be a very specific optimum, and it's specific just to the firm that we're studying, because that firm may have unique characteristics that allow it to have maybe a really high debt load, or encourage it to have a really low debt load. And some people just have a sort of natural aversion to capital structures that are really high debt. So for instance, you see companies like Google and Apple that took a long time where they were only equity financed and they never raised any debt because they just didn't want to be beholden to the promises made to debt holders. And you might find that, of course, we've talked about this a little bit, it's not really part of the class, but you might find that to be true in your own personal life too. Me, for instance, I really don't like loans. And so even though as a good financial professional, I know that they're really valuable tools, I still avoid them like the plague, if I can. And so when we are looking at a firm, we're trying to understand things like that. What's their target capital structure? Because that's going to be really important in implementing a weighted average cost of capital.